Hey, welcome all. Coleman Report Live, the first week of fiscal year 2019, Lance.
Well, it's time to get off to a good start for all of our SBA participant lenders. And SBA has been kind enough during the month of September to pop a lot of changes out.
Yeah, so we're going to go over those, spoiler alert, personal resource test. Hey, thank you all for joining us. If you're new, I know we have some new people for our new training. Go back, Joseph. Download this. We like to make little notes, make it easier for you to go ahead and make notes of our office hours. You can jot these. You can scan these in. Also, there's your certificate. Print that out. Save it in your files. It shows SBA regulators, whoever asks what you're doing for training. And Lance, this certainly qualifies.
Yes, it does, Bob. And it's always important for all of your SBA staff to get training and keep updated on SBA topics.
Hey, we have a ton of stuff. First of all, please send your questions. We love them. We get them during the week. We're going to be talking about a bunch of questions this week. But as you know, we like polls, and we're going to talk about the fiscal year that just ended, 2018. How'd you do? How'd you do, Lance?
Well, Bob, we had a good year, and we're looking forward to even a stronger year in fiscal year 19. I think that 18, there were no real reasons why an SBA department shouldn't have had a great year.
Very good. Very good. Congratulations to those who met and exceeded. And for those who are a little bit low, 2019 is a brand new year. So good luck with that. This is new. We're going to write about this on Tuesday. This just came out in the Federal Register. And the question is, do you believe SBA should adopt a new standard personal resource test for owners to inject, quote, excess, unquote, cash into the small business venture?
And this is an incredibly interesting question, Bob. As you know, a couple years back, they eliminated the personal resource test, but they kind of wound it into the credit elsewhere. But it's once again another gray area in the SOP 5010-5J.
We're going to talk about that. For those of you who said no, I think your fears are going to be a little bit relieved. Lance and I have looked at this. Our initial reaction is positive. Oh, we're going to go into it right now. Let's go to the next slide, Joseph. This is what SBA is proposing. First of all, read the rule. It came out on September 28th. Everyone has the ability to comment on it and say, hey, I like it or I don't like it. But this is what it says, Lance. If we have a loan of $350,000 or less, each 20% owner of the applicant must inject liquid assets that are in excess of 1 3/4 times the total financing package. So if my math is right, on a $200,000 loan, if they have more than $325,000, whatever's over the $325,000 has to go into the business, or $200,000 at the lower level. I think that's a livable standard, Lance. What do you think?
Oh, I agree, Bob. I think most of us do not experience SBA loans where the owners have extremely exceptional cash balances. I think it's fair when they make excess cash more than the amount of the loan. I think it's pretty obvious. If somebody has $325,000 in cash and they're wanting to get $200,000 using an SBA loan, anything above the 325 is pretty obvious. They should inject it into their business.
401ks are exempt. IRAs are exempt. So we're not talking about those nice balances in the retirement funds. We're talking about excess cash. And I agree with you, Lance. If someone has that much, and SBA is not asking for all of it, they're asking for above that standard. So I think my initial review of this, the limits they set, I believe are fair, reasonable, and prudent. Now, you have to be careful. They say the 20% owner, we're going to have a question about that later on, but they also say that includes, Lance, spouses and children. And what they're concerned about are someone who's shuffling stuff to other family members.
Yeah, one of the things that I like about it, Bob, is it just clarifies an area right now that's kind of gray. And right now the credit elsewhere test requires that you look at the personal resources, but there's no definition of what is considered excess. And, you get a loan default, you get into a guaranteed purchase. SBA goes back and looks at the original personal financial statements and they say, hey, they had a ton of cash in a money market account. Why didn't you make them put it in? I prefer, in the SOPs, guys, I love changes where it clarifies. And this is going to be a change that's going to clarify things for us and help us to be more compliant SBA lenders.
Further numbers between $350,000 and $1 million. Each 20% owner must inject anything in excess of 1.5 times, or $1 million, whatever is greater. What they mean is if someone has a $500 million loan, they can have up to $750,000 in free cash without having to inject in the business. I think that's a very reasonable standard. Over $1 million, you can go up to $2.5 million of cash, and it's a one-to-one basis. Again, we want to make sure that the small business concern has, per the 1920, has sufficient resources available to operate for the next 12 months. So we do want to have people that have cash reserves, and when we have hiccups, they have the ability to go in and make the business viable.
Well, again, Bob, small business owners have to have skin in the game. They need to inject monies that they have. And again, the thing I like about this is it's going to help to clarify, and you're not going to get in a position of getting a surprise when you present a guaranteed purchase 5 years from now that you didn't do something properly. So anything that gives us a numerical standard and it's eligibility.
Yeah, it's reasonable. I don't know how many deals the people in the call would have lost over the past year. I would
not very many.
Very comfortable. It would be less than the fingers on one hand. Hey, Lee asked a question. I think I know the answer, Lance, but I'm going to try to stump you. Would cash value life insurance be included in cash consideration?
I don't think so, Bob, because it's similar to an IRA or a retirement account. The only way you can get the cash value of life insurance would be to either cash the policy in, which would result in not having that life insurance, or to borrow against the policy. So cash value life insurance is not going to be included.
Yeah, and I think the underwriter should address that in the memo, but you can say, hey, this is just another capacity resource of the small business borrower. We're not going to touch it. That's for their family planning. That's for their estate planning. But it's there, and we understand that.
Bob, that's my favorite thing on the SBA Form 413, or the SBA personal financial statement, Bob, is cash value of life insurance. You get a lot of good, strong small business owners who think you put the face value of the policy in there, and you don't have $1 million cash value of their life insurance. Bob, I have a policy I've had in place since 1985. Have paid diligently on it. It's a whole life policy, and the cash value of my life insurance policy is $40,000. So.
All right. Well, good for you. By the way, Lance, we need to get you off that telemarketing phone tree that you always get the phone call. Very good. Let's go to Lori. She asked the question. This is a follow-up on the fees on the 159. Can a lender do a cost analysis and come up with a standard fee based on specific components of the work, such as a standard dollar amount per affiliate, collateral, business acquisition, construction? Can we use a flat fee for components on calculating the fee that we're going to charge the borrower for loan packaging?
I think that it depends. You have two ways to charge a packaging fee. One is an hourly rate, where you break it down into components, just like Lori's asking about, and you assign a number of hours and a dollar amount per hour based on who's working on it. You can still charge a percentage of the loan amount within SBA guidelines, but you're still going to have to document the work that was done on the SBA loan package. And that's one of the things we're going to try to clarify in next week's webinar, Bob, how to meet the standard for documentation on the SBA Form 159 in relationship to loan packaging. But the answer to Lori's question is absolutely. And a big question I get over and over, Bob, is, can we still charge a standard fee? The guidance that came out is you can't charge a standard fee. But Bob, if you document your file and show that you've got $4,000 worth of work and you want to charge a discounted fee of $2,500, you can do that.
I agree with you. I think that's legitimate. What SBA wants to get away with is the industry standard that has evolved, flat $2,500 per transaction, whether it's simple or complicated. We need to document it with hours. And I don't see SBA going in and doing a time study analysis and saying, oh, no, you said 5 hours for this function. It's really 4 hours. What they're concerned about is the lender ignores it and they're going to a standardized fee. As long as you're reasonable in coming up with your documentation, I believe you'll be fine.
Well, and again, I think on the fees, the documentation is what's important. SBA realizes that loan amount really has nothing to do with the amount of work that goes into packaging an SBA loan. So when you as a prudent lender, say $100,000 loan versus $1 million loan, they may both take the same amount of work. Now, you may not want to charge the same fee for both loans, but you need to at least document the work that went into it.
Lance, October 10th, you're going to be doing this webinar. I know we'll have some information at the end, but I believe, have you finished your presentation? Are you ready to rock and roll on it?
I just submitted it to Joseph for review yesterday.
Okay, so we're all these specific questions Lance is going to tackle. Hey, Paul asked an interesting question, and we love Paul's questions, and that is, we have a business acquisition loan, and we have two owners. Can we have two separate seller carryback notes?
And the answer is absolutely. I mean, in this case, he's saying 5% cash down and 5% on full standby, but they want to have a note for another 20% that's not on standby. The rules on business acquisition is seller financing that is on full standby can be counted as equity. It can't account for more than 50%, and that's the 5 and 5 is correct. The minimum required equity injection for a business acquisition loan is now 10%. That can consist of 5% cash in, 5% seller financing on a full standby. But the answer to your question, Paul, is absolutely. There can be another seller note for as much as they want to finance, and as long as you're not wanting to count it as equity injection, it can be receive payments of principal and interest, but you do have to include that in your debt service coverage analysis.
Is this transaction, are we making our lives difficult? Is it too complicated? The lender has the right to say, no, we're not going to do that.
Well, one of the reasons I like...
the lender be accommodating?
One of the reasons I like the question Paul is asking, quite often on business acquisition loans, there's a lot of goodwill, and the loan does not fully collateralize it. And being a good SBA lender, you're looking at all available collateral, and you still can't get it fully secured. And of course, as we know, SBA loans shouldn't be declined because they're not fully secured, but you've got a collateral shortfall. One of the ways to improve your position is something like Paul's structure, 5% cash in, 5% seller finance on a full standby, but then the sellers carry another note that helps to cover that gap, that goodwill gap that gets created in so many business acquisition loans. So the answer to your question, Paul, is absolutely.
Melissa asked the question, Lance, you did a great webinar last week on workouts, loan modifications, and deferments. And she says, hey, is there a template that I can use as a guide when I'm sitting down with someone so I know exactly what to do? And if there is, where can I find it?
Well, quite frankly, Bob, in the SOP 5057-2, if you pull it up, do a Control F, type in workout agreement, there is a specific section on workout agreements that give you the steps and requirements of a workout agreement. Now, no, Melissa, I have not seen a template, but at least the SOP says these things must be included and here are the steps you must take.
Great. And it's detailed, and that's what I would go to, Melissa. I would just go down that list. The SBA secondary market is important to those of us who sell the loan to the secondary market. Even if you don't sell it, it's important for a number of other reasons. What we have found and been tracking is premiums have been dropping for a variety of reasons. I can give you a whole lecture, which you don't want to hear. But part of the problem is there were some technical adjustments by SBA that have amped up those prepayment speeds. Remember, there's two components to an SBA loan prepayment. One is it defaults and the SBA prepays the loan from the secondary market, or it's refinanced. And that is more prevalent in today's market because a lot of these variable interest rate loans are being taken out by fixed financing. In fact, I would encourage your business development officers, if you have someone out there with a variable rate loan that is performing, you certainly can go back to them and you can modify the loan, right, Lance? You can modify it with a ceiling. You can choose to take it out on a conventional basis. So there are a number of things that you have rather than losing it to a larger bank down the street that says, hey, this person's performed for 3 years. We're just going to take it out conventionally.
Well, and that's something that you have to always remember in your servicing toolkit. You can modify the loan, and most of those modifications are unilateral servicing actions that just require E-Tran input. A good SBA participant lender, if you've got somebody that's, and it's happening, Bob, because we've had several rate adjustments. Most of these loans that piddled around and never adjusted for years suddenly have had multiple rate increases and the payments are going up. And those borrowers may be feeling stress and looking for a more predictable payment structure. And I understand that. As a small business owner, I would do the same thing. But, if you have a small business owner that comes in and says, hey, we need a more predictable interest rate. We're talking to bank XYZ. They're offering this. You have the opportunity to go in and modify the loan under your unilateral servicing authority. Again, if you do modify the loan, of course, it's going to have to meet your bank's requirements for yield, but you can modify it. Most of those actions are unilateral and just require E-Tran input.
The other questions that were raised is how does the BDO compensation plan tie into the secondary market? It's changed. Last year, we did an analysis on that. And lenders are moving from paying the business development officer as a percentage of the secondary market and going to a flat fee. In fact, there's a top 10 lender who has done away with commissions altogether and pays their business development officers a flat salary on obviously projected performance. The risk to the lender that pays a business development officer as a percentage of the secondary market premium is they may lose that business development officer to someone that does not. It varies back and forth in terms of do you have plans to lower the BDO comp? The answer on that is I don't see BDO compensation lowering because of the highly competitive nature of the market and that lenders want to attract good BDO. So I don't see BDO compensation being hit. Lance, do you have an opinion about that?
Well, it's a very competitive market. The SBA lending skill set is in high demand. Good BDOs that can bring relevant deals to the table are really because of competition. Just like you said, Bob, I don't see that changing dramatically.
The third question is, with the prime rate at its highest point in a decade and premiums at a low, is this going to have an effect on the overall volume? The appetite, the answer is, I see it continuing to increase. The appetite on Main Street entrepreneurs is optimistic, and they're optimistic. They borrow money for expansion. They're hiring people. They're buying equipment. They're buying property. So, no, I don't see the increases in prime rate as affecting the demand side of the small business loan equation, especially when study after study that we've published show that that demand has been tamped down. So that's my opinion. Lance, how do you feel about that?
I really don't see demand slowing down. In fact, I always look back to the recession that we had several years ago, Bob. SBA lending or SBA loan demand in, say, 2010, 2011 was pretty exceptional. And the economy was not good. I think these interest rate increases have more of an impact on your existing portfolio than they will have an impact on the request for new loans from small businesses. And every small business owner that I know feels optimistic and probably are looking to grow.
It appears I missed another slide by Leanne. So let's go back, and it has to do with our hotel financing. And Lance, what's your opinion on this now? For a while, SBA was requiring any minority shareholder, well, I guess one that had more than 10%, to supply the personal financial statement. And so the centers could look at the personal resource cash availability by that minority shareholder. What do we do if someone comes in with 15%?
I'm going to ask for, I'm going to ask for financial statements. I think the hotel industry is its own special market for SBA loans, and the Inspector General certainly has found some instances of fraudulent behavior in hotel lending. So, and we have a bunch of great participant lenders on here, but I'm going to look on most hotel deals. I'm going to try to vet out and look at the financial situation on all owners.
I think that's prudent. Leanne, the answer to your question is SBA is only going to require the guarantee and the financials on 20%. That's in the SOP. But Lance makes a great point that that's the bar, but we can ask for additional information as a prudent lender. And Lance, I agree with you. I want to know who this is 15% owner. Why is it a 15% owner? What else are they involved with? What are the other affiliates? I strongly urge you to get that financial statement to get a big global cash flow picture of all the owners. And even though that person may not be a guarantor, there's financial capacity there that we may be able to rely on. And I think the underwriter needs to know the history of why we have a 15% owner.
In particular, Bob, if the equity injection is coming from a minority owner, you're going to want to see those financials, particularly on hotel deals, guys. If it's been flipped, sold several times during say a 5-year period, this is the third time it's been sold. I'm going to look real hard at all the owners to find out what else they're involved in and what else they own.
Yeah, absolutely. Absolutely. Be careful with that. We have a question on how do we document commissions to a loan broker? The 159, is it sufficient to say we're going to pay a 1% referral fee, put in 1%, put in a $3,500 fee, and is that sufficient for 159 documentation, Lance?
It is on a fee paid by the bank. If
Correct.
The bank is paying, where we need more stringent documentation, more detail is when the borrower is paying the fee. But when the bank's paying a fee to a broker for a referral loan, you can just put the percentage in the amount.
SBA is concerned, to follow up on Lance's, they're concerned about the fees that are being paid by the borrower, by the applicant, not necessarily by the fees by the lender. Those have to be disclosed, but they want to make sure the industry, whether it's a packager, broker, or lender, they are not taking advantage of the fee situation. We've started this secondary market quotes. It comes out now every Wednesday. If you're not signed up on that, shoot us an email. We'll be happy to add you to the list. It's a separate email now, and we do the quotes for both 7A and 504, and you should be aware of that. I think you can go to the website and sign up for that as well. We're rocking and rolling. Great turnout. Thank you very much. Secondary market. Hey, the list price on this is $12.95. If you want a friend of Lance, you're going to be speaking here, but if you want a friend of Lance, discount at $300, shoot me an email. We'll take care of you on that. There's an early bird special, $9.95. We'll honor that. Shoot me an email. and I'll take care of that. This is the only event that deals with SBA secondary market. We bring together four. We bring together the seller, which is the lender, the broker, the investor, and as well as the buyers in Wall Street. We bring all four of those together, as well as SBA. We just got an email confirming from SBA they will be there in force. And so this is a great event. You can talk directly with the SBA officials. And the answer to the question is what's going to happen in 2019, we answered that as well. Very quickly, we released this study yesterday. And it's interesting. It's a 92-page study. I love reading this stuff. Lance, no surprise. Guess what? Smaller banks for startups lend based on relationships. They're willing to make more startup loans than a larger bank. Larger banks, now this is a little surprising. They're relying more on the SBA guarantee than the smaller community banks. The smaller community bank says, yeah, we're going to go for SBA guarantee. But if you walk into one of the larger banks, it's very difficult to do a startup without that SBA guarantee, Lance.
Yeah, and I think that's the reason for the SBA guaranteed loan program. And larger banks absolutely are looking for an SBA guarantee or some other guarantee program to provide financing to startups.
Very good. Let's go to the next slide. These are our webinars upcoming. Please take advantage of them. Lance is going to be doing the 159 one. We have our fall training. Here we go. I'm going to be doing, Lance and I are going to be doing our third annual medical practice professional financing in a couple of weeks. Lance, you're going to follow up with litigation plan, CPC, care and preservation of collateral expenses, wrap-up reports, and also we're going to do, this is a new one, closing the franchise loan. There's been a lot of changes, and so Lance is going to be doing that. We respect your time. Thank you for your questions. See you next Thursday, 1 o'clock Eastern.
Have a good weekend.